Okay, so we are recording. I'm going to spotlight myself. Okay. And so with that, when we left off, we were on slide 27, which was problem 4 of handout number 14. And in problem 4 of handout number 14, we just have a series of questions about the operation of Part 4 tax, which we talked about last week. And so starting off, the first question was asking what kind of corporations are subject to Part 4 tax and on what type of dividends, and moreover, why are these corporations subject to Part 4 tax? And so again, this is kind of a review question that we, that we covered off last week. We hinted at this as well at various other points in the course when we talked about RDTOH, etc. And again, to dig into the technical parts of the answer, Part 4 tax is payable by private corporations as well as by subject corporations, and that's a defined term in subsection 186.3. Effectively, as you'll recall, a subject corporation is a corporation other than a private corporation that's controlled by or for the benefit of a single person or a group of related persons. So, the question is then on what type of dividends, and the answer is an assessable dividend, which is again a defined term in subsection 186.3. And generally, we view assessable dividends as being things like taxable dividends if they're deductible by the recipient corporation under subsection 112.1, or if they're deductible under section 113, which we don't really have to worry about. So basically, if you're thinking of a tax deductible intercorporate dividend paid and received by Canadian corporations, then you probably have an assessable dividend, and that's going to potentially be subject to Part 4 tax. And then it gets to the more theoretical part of the question, which is, well, why? Why are these the corporations that we choose to impose Part 4 tax on? And again, as we talked about in weeks past, the reason why we do this is that we're attempting to limit Part 4 tax to corporations that effectively serve or could effectively serve as incorporated pocketbooks. So in theory, you could probably find a way to use a widely held public corporation as a deferral vehicle, but you probably can't, right? In a sense, Berkshire Hathaway is an example of a public corporation as a deferral vehicle, but by and large, the market doesn't tolerate that. So you're not going to have in real life, that one example aside, a public corporation that is a deferral vehicle. So we don't need them to be subject to Part 4 tax. We really need private corporations and things that are just serving as a proxy for private corporations to be subject to Part 4 tax. Then question 4 goes on to ask if a corporation, must be a private corporation at the time that a dividend is paid to be eligible for the dividend refund. How might this condition affect the refundability of Part 4 tax? So it's, as it says on the slide, a simpler version of this question is, how does corporate status impact a refund of Part 4 tax? And so again, as mentioned in the problem, in order to be eligible for a dividend refund under subsection 129.1, a corporation has to be a private corporation at the time that the dividend was paid. So if you have a change in corporate status from a private corporation to anything other than a private corporation, so either to a public corporation or to a corporation that is neither a private corporation nor a public corporation, then you could have an issue with your dividend refund. So if you were a private corporation and you had to pay Part 4 tax, and then you cease to be a private corporation between the time that you paid the Part 4 tax and before any dividends were paid to the shareholders of the corporation, then the private corporation would lose the ability to claim the dividend refund in respect to the Part 4 tax under subsection 129(1). So again, this goes back to an important planning point as part of a checklist for when you have a corporation that's being sold, is or if it's going to go public or something like that, is make sure that there is no eligible RDTOH or non-eligible RDTOH sitting around, because if you don't recover it before the change in status, you're, as a practical matter, never going to be able to recover it. So pretty important to keep a handle on that. And then finally, and we sort of just answered this, is that the question then asks, okay, well, how does the status of the corporation impact the liability for Part 4 tax? And again, the corporation is liable for Part 4 tax if it's a private corporation or if it's a subject corporation. And generally speaking, although not always, if you're going to create an non-eligible RDTOH balance or an eligible RDTOH balance, you would need to be a private corporation to do that. However, subject corporations can also maintain and add amounts to a non-eligible RDTOH balance or an eligible RDTOH balance to the extent that they receive dividends that are subject to Part 4 tax, and can, in fact, in limited circumstances, also receive a dividend refund. So, an important point. But generally speaking, again, to be liable for Part 4 tax or to maintain an RDTOH balance, the corporation needs to be a private corporation. So that is our kind of basic parts about Part 4 tax. And so we can flip over to slide 28. And slide 28 is dealing with problem 7 in the handouts, and it's asking about connectivity. And so again, we talked about connectivity a little bit last week. And the point about connectivity is that corporations are connected in two circumstances, both of which, and I guess we should say both of these ways that they can be connected are defined in subsection 186.4, although with some modifications under subsection 186.2 for control or 186.6 if we're dealing with a partnership. But generally speaking, two ways that corporations can be controlled. Corporations can be connected. First of all, corporations can be connected under paragraph 186.4a. If it controls the dividend payer, then the controlling corporation is connected with the dividend payer. Or second, the corporation can be connected with a dividend payer if it meets a votes and value test in paragraph 186.4b. And that is a more than 10% votes and more than 10% of the voting shares and more than 10% of the fair market value of all of the shares combined votes and value test. And again, like we said last week, very important to keep in mind that that is a more than test to be connected. So it's not a 10% or more, it is a more than 10%. And again, we talked about how it's very important in the world of income tax that whenever there's a numerical threshold, you should always be looking at the Act to make sure that you're actually getting the correct numerical threshold and you're not making assumptions, because that tends to get people in trouble and has gotten people sued in the past where they've made an assumption and been wrong about 10% or more versus more than 10%. So important. But then the question is really asking us about in question 7 is, well, at what point is the connectivity determination made? And, the Act isn't exactly explicit about this, but what you can see in subsections 186.1 and subsection 186.4 are the magical words "at that time." And so basically, whenever you see the words "at that time," you know that you're dealing with a point in time test. And where the provisions don't specify what that point in time is, then the point in time is the relevant time, where the determination becomes relevant, which in the case of Part 4 tax is the moment when the dividend is paid and received. That's the relevant time. So if at that time you satisfy the connectivity test, then everything is good. There is one trap actually on this point in time test, which is, I will mention, it's a little bit outside the scope of this course, but given that it's been written up a couple times in the last 12 months, and we have seen some people walk into it in the last 12 months, probably worth mentioning, is that where the point of time test does not work the way you think it does on connectivity is if you have a corporation that is a beneficiary of a trust, and then you have a corporation, the shares of which are owned by a trust, and the corporation that's owned, the shares of which are owned by the trust, pays a dividend, and the trust makes an allocation to the beneficiary corporation. Obviously, as you may or may not know about the taxation of trusts, is that the character of income in many instances gets preserved, and taxable dividends are an example of one of those times where character preservation does happen. And so in that case, it's not actually really a point in time test where you have an allocation to the trust. It's actually at the end of the year, at the end of the trust taxation year, is the relevant point in time, because the character doesn't actually carry through until the trust makes designations at the end of its taxation year. So that is a bit of a trap. And it becomes, where it really burns people is where the corporation, the shares of which are owned by the trust, is being sold, and it pays a dividend prior to being sold, and the dividend is allocated at the end of the trust taxation year to the remaining corporation that was a beneficiary of the trust, because at that point, since the corporation that paid the dividend has been sold, at the end of the trust taxation year, the corporations couldn't be connected. And so you have Part 4 tax on the intercorporate dividend, which generally speaking, if you're paying a dividend in that circumstances, you're expressly intending that it not be subject to Part 4 tax. So that's a trap with connectivity, but otherwise, like I said, connectivity is a point in time test, and the point in time is the relevant time, and you'll know the relevant time when you see it. So then then we get into a very theoretical question in the back half of problem 7, which is just asking, is this threshold for connectivity too low, that you have to own more than 10% of the voting shares and you have to own more than 10% of the fair market value of all of the shares? And this is one of those things where everybody can have a different opinion about this. And I have an opinion that may not be the same as yours. My opinion is that it depends, which is not a very helpful opinion in most instances, but here it is that it depends on the size of the investment in absolute terms, right? That if for example, you're acquiring 10.01% of a bricks and mortar retail store or a restaurant, which I guess in 2020 or 2021, you can probably get 10.01% of a restaurant for about free. That's not a very large absolute investment, right? It's not a very large financial commitment. And the person who's making an investment on that scale, there's a pretty good chance they're not active in the business at all, right? And that this is effectively just a portfolio investment for that person, at least from the perspective of the investor. From the perspective of the investee corporation, 10.01% is still a significant investment. But from the perspective of the investor, pretty good chance it's a passive investment, part of their portfolio of various investments. And they may not have a lot of power to choose directors or to dictate kind of corporate decisions or anything like that. In contrast, again, and this goes to the absolute size of the investment, if you owned 10.01% of a large public corporation, especially if it's a very widely held public corporation, there's a pretty good chance you're the largest shareholder of that corporation at 10.01%. Pretty likely that you're going to have a disproportionate say in the election of directors and in the setting of corporate policy, and dictating if there's going to be share buybacks or dividends or all that kind of stuff. Pretty significant, right? Especially because retail investors tend not to vote their shares. And so if you're really voting 10% of the shares in the absolute, but you're probably voting a much higher percentage of the shares that will ever actually be voted. So pretty important, right? In that case, that's a investment probably in the billions of dollars, and it's very significant. So that probably is 10.01% maybe too high a threshold in that circumstance rather than too low. However, I think where we come back to is that the Act is pretty consistent. Why 10% was chosen, even if it's potentially too high or too low, is the Act is pretty consistent in using 10% as a saw-off for a lot of things. So, for example, whether we have a foreign affiliate or not, as an example, is a 10% saw-off as well. So it's subject to that more than versus equal to issue that's especially relevant in the Part 4 tax context. There is a degree of consistency by using 10% as opposed to some other threshold. Although, interestingly, Part 6.1 tax, which operates kind of like Part 4.1 tax but serves a different purpose, and which we're not going to really talk about in this course, that uses a 25% threshold to have a substantial interest. And, again, you may or may not have your own opinion about whether for Part 4 tax purposes a 25% threshold would be more or less appropriate than the more than 10% votes in value threshold. So then we can move on to slide 29, and we have problem 8 of our handout. And in problem 8, there's one thing I did want to note is that we have a comment about a combined federal provincial rate of 12.5%. That's a ghost from prior years. That should be combined federal provincial rate of 11%. But anyway, in the handout, the problem asks us to assume that YCO owns 10% of the voting shares of XCO, and that those shares also represent 10% of the fair market value of the outstanding shares of XCO. XCO earns $100 of active business income eligible for the small business deduction and distributes the after-tax cash to YCO. What are the tax consequences for YCO? And then there's some follow-on questions which we can get to after we answer that main question. So going through our main question, what we have to do first of all is we have to make an assumption here, right? We know that 10% of the votes is not enough to control de jure, right? So we would think normally that paragraph 186.4a doesn't matter. But we do have to keep in mind the expanded definition of control in subsection 186.2. And so we do have to think a little bit, or at least make an assumption about the other shareholders of XCO. And so specifically, we're going to assume that persons who do not deal at arm's length with YCO do not own 41% of the shares of XCO that are not owned by YCO. So even when we consolidate our shareholdings with all non-arm's length people, YCO does not control XCO. So then we know they're not connected on the basis of paragraph 186.4a. And so we can look at paragraph 186.4b. And again, this problem is reiterating the trap that I've mentioned with Part 4 tax, in that it's a more than 10% votes in value test. And what we see here is that YCO owns exactly 10% of the votes in value of the XCO shares. So YCO does not meet the paragraph 186.4b threshold, and YCO is not connected with XCO. So as a result, then we know that we're going to have Part 4 tax on the dividend that's received at the 38 1/3% rate in paragraph 186.1a. So working through our problem then from that starting point, we know that EXCO is a CCPC and therefore a taxable Canadian corporation. And we know its dividend that it's paying is being paid out of active business income, or at least we assume, given what the problem is saying. So we know it's going to be a non-eligible dividend that it's paying out. And so when that dividend is received by WICO has to include the dividend in income under paragraph 12(1)(j), but it gets to deduct a corresponding amount under section 112. So it's flat, right? EXCO is flat from Part 1 tax for Part 1 tax purposes. However, again, because WICO is a CCPC and a private corporation, and it is not connected with EXCO, so it is going to be subject to Part 4 tax under paragraph 186(1)(a) at the rate of 38 1/3% of the dividend received. The dividend was $89. And so we should have a Part 4 tax liability of $34.12. And so if you're using classic RDTOH, which is, like I've said in weeks past, is your right in this course because it's easier, it would be the amount of the Part 4 tax paid would be added to classic RDTOH under paragraph 129(3)(b). If you're using real life, non-eligible RDTOH, then the Part 4 tax paid, again, because we're assuming this is a non-eligible dividend, would be added to WICO's non-eligible RDTOH as defined in subsection 129(4). So then we have from there the next part of the question kind of flows nicely from here is what happens if WICO pays the dividend? So here we would assume that because there's a non-eligible dividend, and we're going to make an assumption that WICO has no other activities and that WICO is, et cetera, no other activities. So we're going to assume it has no GRIP balance. So when WICO pays a dividend, it's going to be paying a non-eligible dividend. And again, if we assume that the dividend is $89, which corresponds to the dividend that WICO received, then WICO should be entitled to a dividend refund under subsection 129(1). Since the $89 dividend is exactly 2.61 times its non-eligible RDTOH balance or RDTOH classic balance, whichever one you want to use, then it should be entitled to the full amount, to the full dividend refund of $34.12 that equaled the Part 4 tax that it had to pay when it received the dividend from EXCO. So we have a shareholder Y who is the individual shareholder of WICO. And so this non-eligible dividend is going to be received by our shareholder Y, who is going to have to include that dividend in income under paragraph 82(1)(a), and is then going to have to add the 15% gross up under subparagraph 82(1)(b)(1), which means that our shareholder Y is going to have $102.35 of income in the current taxation year. We would then compute tentative federal and Alberta tax for Y, which we would do by just taking that $102.35 and multiplying that by 0.48. And that gives us $49.13 of tentative Canada and Alberta tax payable. However, our individual shareholder is not done. Individual shareholder Y is then entitled to a federal dividend tax credit equal to 9/13 multiplied by the gross up amount under paragraph 121(a), and that should be $10.38 as a credit against tax payable. And similarly, under the Alberta Personal Income Tax Act, paragraph 21(c), Our individual shareholders should be entitled to a dividend tax credit of 149 over 890 multiplied by the 15% gross up, which should translate to $2.51 dividend tax credit in Alberta. So that's the base case in that problem. But then the problem goes on to ask, well, okay, so what happens if instead of more than 10%, we had 25%, or sorry, instead of exactly 10% shareholdings, we had 25% shareholdings in XCO. And this is a very material change in the facts, and it makes the answers to the problem materially easier, right? Because now if we're clearly at 25%, more than 10% of the votes in value, and therefore XCO and YCO are connected within the meaning in paragraph 186.4b. And so as a result, we know that Part 4 tax, if it's imposed at all, is going to be imposed under paragraph 186.1b. And it's going to basically be equal to the dividend refund effectively that's received as a result of the dividend paid. And in our case, since we're assuming that XCO has no investment income, it just earns small business deduction eligible active business income, then we would assume that there's probably no dividend refund that's received by XCO as a result of paying this dividend. So there should be no Part 4 tax when the dividend is received under paragraph 186.1b. And so as a result, things are really easy. There's no Part 4 tax, and all we have to do is just say that YCO has to include the dividend in income under paragraph 12.1j, and it claims an offsetting subsection 112.1 deduction, so its Part 1 income is flat, and there's no Part 4 tax. So that difference in the shareholding threshold makes things quite a lot easier. Okay, is everybody okay to this point? Okay, seeing nobody, we can move on to slide 30 and to question 9 of our handout. And so this is a problem that's intended to illustrate how paragraph 186.1b works when we actually have a refund of RDTOH in the system with connected corporations. So in our example, we are we are assuming that in the above example that XCO earns $100 of interest income instead of active business income, pays a taxable dividend of $80 to YCO, which holds shares representing 25% of the outstanding votes in value. So what are the consequences of the dividend payment to XCO and YCO? And what if YCO holds shares representing 10% of the votes in value instead? So we'll get to the alternative in a second, but let's work our way through this problem. So starting where we left off in problem 8, we know that because we're specifying 25% votes in value, the corporations are connected, right? So we know we're going to be in paragraph 186.4b, and as a result, we know we're going to be dealing with Part 4 tax under paragraph 186.1b. So not the default 38 1/3, but the lesser of 38 1/3 and the dividend refund caused by the dividend. So where we start is with XCO. And we know that XCO earned $100 of active business income. Sorry, not active business income, of interest income rather, instead of active business income. So we know that XCO, being a CCPC, because in the last iteration of the problem, it was entitled to the small business deduction. So we know it must be a CCPC, and we know therefore that it must be subject to refundable taxes and the RDTOH regime when it earns interest income. So here we have $100 of interest income. Therefore, we should know that EXCO would have added $30.67, which is 30 1/3% of the interest income, either to its RDTOH Classic, if we're using RDTOH Classic, under paragraph 129(3)(a, or it would have added the $30.67 to its non-eligible RDTOH under the definition of non-eligible RDTOH in subsection 129(4). Then we know that when EXCO paid the $100 dividend, and if we assume that this is the only dividend that it paid in the year, it paid an $80 dividend, which is exactly 2.61 times the non-eligible RDTOH or RDTOH Classic balance. Again, we assume that because it's a CCPC and we haven't done anything to earn general rate income, that we'd have no GRIP, so it would be a non-eligible dividend, and therefore the full amount of the RDTOH or non-eligible RDTOH would have been refunded as a dividend refund under subsection 129(1) to EXCO. So then with all of that kind of in the background, we can flip to WICO and what happens to WICO. So again, we know that because WICO is a private corporation that is connected with EXCO, it's going to have Part 4 tax payable. And again, first of all, it's going to have Part 1 to deal with, and Part 1 is easy. As with all of the other examples, WICO is going to have to include the dividend in its income under paragraph 12(1)(j) and then claim an offsetting deduction under subsection 112(1). So Part 1 tax is flat. Then when we flip over to paragraph 186(1)(b), we're going to have Part 4 tax equal to the lesser of two amounts. Okay, one of those amounts is 38 1/3% of the dividend received, and the other option is going to be the amount of the dividend refund that was received by EXCO in the taxation year, prorated across all of the dividends that EXCO paid in the taxation year. So in this case, if we're assuming that EXCO paid only the single $80 dividend and it received its refund of RDTOH, then we would be assuming that that all of that RDTOH is effectively allocable to the dividend that's received by WICO. And so when we multiply that $80 dividend by either by 38 1/3, or we look at the prorated dividend refund that was received by EXCO as a result of paying the dividend, it should be $30.67 of RDTOH, of Part 4 tax, excuse me, $30.67 of Part 4 tax that is payable by WICO when it receives a dividend, and that $30.67 is going to be added to RDTOH Classic under paragraph 129(3)(b, or it's going to be added to non-eligible RDTOH under the non-eligible RDTOH definition in subsection 186(4). So again, interesting in this case, it's actually the same result as in the prior problem, because we had it'll be the same result in the prior problem, just because we had exactly enough RDTOH in EXCO to cause the Part 4 tax, even for a connected corporation, to be effectively the same as it would have been even if the corporation was not connected. So we get to the same place, although you can see how we might not have got to the same place if, for example, EXCO had earned a mix of active business income and interest income and not just $100 of interest income. And I guess we can also just add again that if, as in our past examples, YCO paid a dividend to its individual shareholder Y, then YCO would have received a dividend refund. So it would have got the Part 4 tax back, and YCO would have had to pay tax on the corresponding $80 non-eligible dividend. So that kind of spoils the alternative, right? The alternative is asking, well, what happens if there was only 10% votes in value instead of 25? And if that happened, then we would just be exactly back to where we were in problem 8, in the main example in problem 8, where the full dividend, they wouldn't be connected anymore. So the full dividend of $80 would have been subject to Part 4 tax, because the Part 4 tax rate, again, is 38 1/3%. It would have been the same $30.67 of Part 4 tax that was payable otherwise. Same RDTOH addition / non-eligible RDTOH addition, and same dividend refund when YCO pays an $80 dividend to its shareholder. So is everybody okay there with problem 9? Okay, again, seeing nobody, we can move on to slide 31 and problem 10. And so this is, we're now back to less numbersy questions and more conceptual questions. And so the problem is very simply asking, first of all, why do we have paragraphs 186, 1C and D? What are they intended to do? And we talked about paragraphs 186, 1C and D either last week or the week before. And again, fairly straightforward here. The idea is that if the corporation that is subject to Part 4 tax has Part 1 tax losses, then the corporation can elect to use those losses to reduce its Part 4 tax payable. And so the problem then asks, well, why would we want to do this? And the reason that this has happened is that clearly the Department of Finance has decided that a deferral of corporate tax or corporate refundable taxes, or the elimination of corporate refundable taxes and therefore deferral of personal income tax, is acceptable where a corporation has non-capital losses. And probably the reason that we're doing this is that we don't want dividend income to be treated less favorably than other forms of income for in terms of a deferral. So for example, if a corporation had $100 of non-capital losses and it earned $100 of interest income, then it could use under Part 1, just in the ordinary course, could use the $100 of non-capital losses to reduce the $100 of interest income. And as a result of doing so, that would kill the $100 of interest income, and there would be no refundable taxes and no obligation for the corporation to make a distribution to its shareholders in order to recover refundable taxes. So by having paragraphs 186, 1C and D, we effectively level the playing field between dividend income and interest income or rents or some other kind of income that's dealt with under Part 1. The other thing is that it may be that the corporation just, for whatever reason, has ceased carrying on its business and will just never earn any more Part 1 income, but is still earning dividend income from, let's say, a portfolio of marketable securities. So if we didn't allow the corporation to use its non-capital losses against the dividend income in order to at least get the shareholder the benefit of the continuing corporate deferral, it might never be able to use the non-capital losses. So this is at least a use that we're giving to the shareholders. Is everybody okay there so far? Okay, so then we can move on to our last thing with Part 4 tax before we pivot a little bit. And this is slide 32 and question 11 of the handout. And it's asking, when is Part 4 tax due? And the way you need to figure this out is, first of all, you flip to subsection 187.3. And that provides that the provisions of Part 1 relevant to the assessment and collection of tax are also applicable to Part 4 with such modifications as may be required in the circumstances. And so this means that the balance due date, or balance due day rather, for Part 4 tax purposes is the same as the balance due day for Part 1 purposes. The term balance due day is defined in subsection 248.1. And for a corporation, it's generally the day that is 2 months after the end of its taxation year. So that will be the balance due day for Part 4 tax. Then the question goes on to ask, how can you create a 1-year deferral of Part 4 tax? And if you've been following along closely, this might be something you've thought of when you looked at the handout. The way that you would do this to create a 1-year deferral of tax would be to stagger corporate year ends. So for example, if you had a large Part 4 tax liability, but you thought you would have some losses in the corporate group and you wanted to just push it in order so that you could generate the losses. And then use paragraphs 186, 1C and D to eliminate the Part 4 tax. Well, then what you do is you would just create a chain of corporations with staggered year ends. So you would have, for example, the corporation that would become liable for the Part 4 tax would have a December 31st year end, and the corporation that owns all the shares of that corporation, which we'll call Midco, would have a December 30th year end, and the shareholder of Midco, which we can call Holdco, would have a December 29th year end. And so what you do is on December 31 of the year in which the Part 4 tax became payable, OpCo would pay a dividend to Midco in an amount large enough to cause a dividend refund to get the Part 4 tax back. So that's our December 31 of year X. We have the dividend refund. Midco becomes liable for Part 4 tax, but it doesn't have to pay that tax until December 30 of year X plus 1. And so what it's going to do on December 30 of year X plus 1 is it's going to pay a dividend refund. It's going to pay a taxable dividend to Holdco, and it's going to receive a dividend refund. So it's flat in that year that ends on December 30 of year X plus 1. And then Holdco is going to become liable for Part 4 tax as a result of receiving the dividend in its taxation year that ends December 29th of year X plus 2. And so as a result, if we just did to here and this is okay, well, now we're going to remit the Part 4 tax. The Part 4 tax would be due on February 25th of year X plus 3. Whereas in our initial, if we had done nothing, the Part 4 tax would have been due February 28th of year X plus 1. So you can just by continually adding more corporations to the stack, you could just generate an indefinite deferral if you did that. I don't think anybody has ever done this in real life. You might do it so it's the Part 4 tax becomes kind of circular if you just need 1 year in order to generate some losses or whatever else to kill the Part 4 tax. But generally speaking, the deferral isn't worth enough that you're going to engage in in this kind of chicanery where you would just continually create new corporations with one-day offset year ends and just continually pay up Part 4 tax dividends in order to receive a dividend refund and just defer the payment of the tax. In theory, this seems like the sort of thing, if you kept doing this, that the GAR would probably apply at some point in order to prevent that. Back in the day when partnership deferrals were more of a thing, there was a case called Fredette that basically stood for the proposition that doing a deferral for 1 year was okay, but if you started to get into just multiple year deferrals with multi-tiered partnerships, that the GAR would apply on year 2, and probably with a stack of corporations, a court would find a rationale to apply the GAR at some point before too long. So an interesting way to get a 1 year deferral, but not necessarily something that actually happens frequently in real life. So with that, we can pivot away from Part 4 tax for a couple slides, unless anybody had any questions about Part 4 tax. And if not, okay, we can pivot to slide 33, which is asking about tax on split income, aka TOSI. And this is a real world concern that was has been enacted since the point where I started teaching this course. And it's something that if you're practicing in Edmonton, you will get asked a lot about TOSI. What TOSI is it is an additional tax that applies beyond your usual Part 1 tax liability. And the idea with TOSI is that you're trying to prevent income splitting between family members. So for example, let's use a really classic example. Suppose that we have doctor and her stay-at-home husband, right? And so doctor creates a professional corporation, and the professional corporation earns doctor's income. And let's suppose doctor wants to spend $300,000 a year of that income. Doctor, if she pulled that money out as salary from the professional corporation, would obviously be entitled to a deduction in the professional corporation, but would be paying tax at pretty close to the top marginal rate. So a little bit she wouldn't quite hit the top marginal rate, but would get pretty close to hitting it. So let's for all intents and purposes call it the marginal dollar there is going to be subject to tax to 48%. Whereas what doctor might think would be better would be that instead all the money would be retained in the corporation. It would pay tax probably at the 23% general rate, unless doctor is a solo practitioner and paying tax at the 11% small business rate. And then corporation would pay eligible dividends out of its general rate income to doctor and to husband. And since, in this case, doctor's taking zero salary, doctor and husband would both be starting from zero, and they would be subject to tax at roughly, let's call it a combined federal Alberta rate of around 35% on their marginal dollars. And since these are eligible dividends and you have the dividend tax credit, considerably less than that on eligible dividends. And so as a result of doing that, between the corporation, doctor, and husband, the $300,000 would be subject to tax at a rate, combined corporate personal rate, that is much lower than, much lower than 48% in all likelihood. So you've achieved an absolute tax savings through income splitting. And what the Department of Finance decided in 2017 was that this was a garbage result. They thought that this offended all kinds of vertical equity and horizontal equity principles. that especially it allowed people who were in the professional class to take advantage of opportunities that weren't available to highly salaried employees, for example, or to other people whose spouses worked and who weren't able to income split in the same way, et cetera, et cetera. So finance did not like that, and they didn't introduce, TOSI was always around to prevent dividend splitting with minor children, but they extended it to now to cover spouses and adult children. And so the idea is that if you have an amount of split income, which generally includes dividends from a private corporation, then what happens is that amount is subject to an additional tax under section 120.4 that is equal to the top marginal rate, and there's equivalent provincial taxes, so it would be subject to tax at the top marginal rate. And then the person who received the assessment for TOSI gets a deduction under paragraph 21 WW that reduces their Part 1 income by the amount of the split income that was subject to TOSI. So the idea here is that it just completely prevents income splitting, that you know that if the high income taxpayer would not have been subject to tax at the top marginal rate on the marginal dollar of income received, then TOSI is just a penalty because the person who received the split income is taxed at the top marginal rate. And if the taxpayer, the high income taxpayer, was subject to tax at the top marginal rate on the marginal dollar of income, then the income splitting is pointless because the spouse who received it is subject to tax at the top marginal rate. It's actually a little bit potentially worse than that, just because you can only claim foreign tax credits and dividend tax credits generally against TOSI. So, for example, if the spouse had charitable donations that would otherwise have reduced Part 1 income tax payable, then that's not allowed, and so you're actually, again, potentially worse off. But that was the idea with TOSI. So conceptually, if we flip to slide 34, there's a bit more of the details on how TOSI actually works. The analytical framework is first to determine if you have a specified individual. Basically, everybody is a specified individual, so that's really easy. Next, we have to look to see if you have split income. Generally speaking, it's really easy to have split income. Dividends from private corporations, interest payable by private corporations, et cetera, et cetera. There's equivalent rules for partnerships and amounts flowed through trusts. All of that is split income that is potentially subject to TOSI. Not, as it says on the side, not employment income, not income from marketable securities, whether those are like publicly traded bonds or publicly traded shares. So nothing like that. But generally speaking, everything in the private company world other than employment income is potentially split income that could be subject to TOSI. So since basically everybody you're going to care about in practice is a specified individual and is earning split income, then the challenge with TOSI is to find an exception. And there are, by our count, 14 different potential exceptions to TOSI that you can try to, and the exercise with TOSI is to try to plan your way into one of these exceptions, right? So, for example, if your high-income spouse is over the age of 65, then there's an exception that you can split with the lower-income spouse. If the spouses are divorced, then the former spouse gets to basically rely on the high-income spouse's exceptions to TOSI that would apply to the high-income spouse. If the high-income spouse dies, then the low-income spouse gets to basically be treated as though they were the high-income spouse, so all the exceptions applicable to the high-income spouse apply. If you have shares that you receive as an inheritance, then again, those shares you would be treated as, the same way that the former owner of the shares who's now dead would be received. So again, you step into their shoes. You could have an excluded business. So if you're engaged in a regular, continuous, and substantial manner in a business carried on by the corporation, then you can earn unlimited dividends from the corporation without being subject to TOSI. If the corporation doesn't carry on a business at all, it just earns passive income with no real human activity at all, for example, or if there's no person who's related to the individual receiving the split income, then there's no related business, and therefore there's an exception to TOSI. If the individual is earning a reasonable return, so they've invested capital in the corporation, whatever dividend or interest they're receiving is a reasonable return on invested capital, and generally they're over the age 24, then again, there's an exception, and so on and so on, right? So it's just a matter of slotting your way into exceptions in order to get out of TOSI. But this is a pretty significant deal, right? Because we talked about earlier in this unit, which I realized was now like 2 weeks ago, or potentially 3 because we had Radio Week. So it was a while ago, but we talked about how dividend splitting is a thing, that because the corporate rate is flat effectively, and because the personal income tax rates are based on assumptions about the applicable corporate rate, or sorry, rather the personal tax rate is based on assumptions about personal income, and therefore the credits are flat regardless of income, that if you have lower income taxpayers, you do have the ability, you would have had but for TOSI the ability to split and pay tax at a lower effective rate than if the income had just been earned directly. So TOSI puts a real stop to that in the private company space. And like I said, it's a significant issue in practice. If you're working in Edmonton or Saskatoon or somewhere like that, you're going to get lots of questions about TOSI in real life. If you're working somewhere like Toronto, Montreal, Vancouver, Calgary, maybe not. But important thing. It's not going to be something I'm going to examine you on or anything like that, but it's something to know that it's there in section 120.4, and to make sure you're always thinking about it when you are paying dividends or interest or anything else from a private corporation. So with that is the end of that unit of unit number 6. Does anybody have any questions about that before we take a break and then move on? Okay, seeing none, let's take 10 and we'll come back at 2:13.